Welcome to today's video, and we are starting a new series called Talk of the Town, where we are going to be covering a range of topics that become popular amongst investors, and we are going to be addressing them and giving you our thoughts on that. So the talk of the town recently has been precious metals. It has been catching every small investor's eye, and it's become a conversation that is being spoken about by everybody. World Gold Council has published data that gold this year has moved up by 50% and silver close to 60%. And there is also a lot of perception about how these assets are very safe and they do well over a period of time and never go down. So how does this fit into the bigger picture of asset allocation, and how should an investor today be approaching these two assets?
I think that's a fair and rather interesting point to bring up, right? This is contextually very relevant to have this conversation about precious metals. And when we think about asset allocation, of course, you want a little bit of everything in your portfolio. But really, for asset allocation to work for you, you need to buy assets at the right price. And you've brought up some interesting data points on how gold and silver have performed this year. So, and this is not normal performance for an asset class like that, right? So to take cognizance of it now and buy at such a higher price, an investor really needs to think about what is left for them to make in terms of returns. So asset allocation is always going to be a relative valuation kind of decision. So you want to look at what are the other asset classes that are available to me today, which could potentially create some wealth for me. And if I do a quick back of the envelope calculation, right, some of the more aggressive price targets that I've seen for, say, a commodity like gold is about $6,000 an ounce. And today it's somewhere between $4,000, $4,100.
Right.
So if I see that, okay, this asset is going to go to $6,000 in 3 years, now it looks like a pretty fantastic return, right? I'm doing $2,000 or 50% increase. But when I look at that as a compounded return, it's about 14.5%. Now, every investor is told that, when you look at return expectations from an actively managed equity fund, you should anchor your expectation between 12 to 15% because that's a very achievable kind of return. So with equity, you're achieving a normal return. You're not relying on some unusual circumstances to deliver that kind of return. Whereas with gold, you're expecting, again, a very unusual set of circumstances to last for long enough for you to get an unusual return from this asset class. So I definitely think you are taking a higher level of risk, targeting that same kind of potential return from a precious metal asset class today. Now, we talked a little bit about equity, but I think if you were looking at debt also as an asset class, it offers a little bit of value, maybe in a different perspective, right? We look at gold not just for the return potential, but also the nature of the asset class, which people perceive to be very safe. Now, fixed income is definitely not going to give you a 14.5% kind of compounded return, but it can give you comfort in terms of more stability. It is a cash flow based asset, unlike precious metals, which means you have some earnings that come in, and compounding at a lower rate of return for that stability kind of makes sense. And today's context, you've actually seen debt underperform in a year of rate cuts. So it creates a very attractive re-entry valuation point.
So you brought up a point about fixed income and how this year probably we have seen some kind of volatility and drawdown in fixed income. But usually the perception around metals is that it always rises when you hold it for a long period of time, and the prices of gold has never gone down, and if you hold it, it is going to go up. And in general, people think it's a very safe haven for us to be having assets in. But have we seen drawdowns in the past? How does one handle that? And what are you supposed to do from an asset allocation standpoint when you see these things? And is a drawdown even possible?
Okay, so let me ask you a little bit of an interesting question, right? So we all agree that we are in a bull market as far as gold is concerned. And it's not something that started this year. I think even if you look, say, 5 years back, you were still in a phase where gold was a performer. Now, let's rewind, say, 6 years ago. And you see that gold has moved up, and it kind of peaks out in 2020 because there were a lot of fears around COVID, the pandemic, how the global economy would function and all of that. So gold actually touched a peak of around it crossed $2,000 an ounce in that year. Now, over the next 2 years, gold declined, like gold prices actually declined, right? And what do you think that decline number would have been like? Do you think it was, say, 5%, 10%, 15%, 20%, 50%? What do you think that decline was?
Probably 5%.
And that's what most people assume, that you retain that purchasing power, but actually over the next 2 years, gold lost close to 20% in value.
Oh, okay.
And we've come up from there as well. So I think in a 5-year period, you can see gold prices double. So we went from $2,000 an ounce to $4,000 an ounce. But the in between, it also fell 20%, which a lot of people don't really pay enough attention to, right? There are steep drawdowns even in a bull market. So even if you're long-term very positive about gold, either you need to be mentally prepared that you can lose money in gold. It's not that the prices are always going to go up. That is like when you look at the long-term chart, yes, the value of gold is going up, but that's the same narrative that you see with the Nifty index as well, right? People will tell you that, oh, in 1990, if you had invested 10,000 rupees in the Sensex, then today it would be worth like so many crores, which doesn't really hold fort. Like you need to experience the drawdowns also in between.
Correct. So I think we have spoken about gold quite extensively. Now the next thing that's making the news is silver, and a lot of funds have stopped subscriptions. Is there actually a rush in this space? Or how should someone even approach owning silver? Like, should they be doing only digital silver, or should they be looking even at like buying physical silver at this point? But what is actually happening with silver? I think gold, most people still understand, and it's quite easier to understand for investors. But silver is slightly more different than gold.
You're absolutely right. I think silver as an asset class tends to be a lot more volatile than gold, and there are different drivers in terms of return, right? Because when you're looking at silver, it's also an industrial asset.
Correct.
It's not just a metal that's a store of value. You do see real world applications, and much of the silver thesis is around how these real world applications are sort of expanding. But again, we need to come back to the drawing board and look at how silver really functions. And this point that you brought up, right, about how mutual funds are announcing that they're closing subscriptions, we need to really understand how the market in India works. Now, if you're a mutual fund or an asset management company and you're creating units of a silver ETF, you need to have physical silver to back up each unit that's created. You can't just create units out of thin air. You actually have to buy physical silver and then create units against the silver that you have. Now, prices have been going up, and it's happened very quickly. So there is a sense of like, okay, do you want to stock extra inventory at a higher price or not? Because there is a risk that prices could reverse, right? So then for delivery of physical silver, that's where we are actually stuck today. That delivery of physical silver for new unit creation is not there. So funds have stopped allowing subscriptions into silver units. So then what's trading in the market is trading at a premium, because it's just completely driven by supply demand and not really so much by the price of the underlying asset, which is silver. Now, overall, yes, we are in a deficit in terms of let's say the projected demand for silver versus like the actual silver that's available globally. Yes, we're in a deficit. But then this is predominantly a recycled metal, right? This is not a metal that gets mined. So I think how much of that deficit really matters. And you want to also study another data point in terms of if you're trying to assess whether there's a real shortage versus like, are you seeing a temporary sort of imbalance in terms of supply and demand? You want to look at something like the futures curve, which would tell you how are silver futures contracts priced, say, 1 month down the line, 3 months down the line, 6 months down the line. And when you look at those data points, what you're really getting as a picture is that silver prices are maybe flat or mildly positive in this segment, right? Which is normal, because you expect that storing and owning an asset is going to add to the cost of that asset in the future, which is why your future prices will tend to be a little bit higher than the current prices. But in today's market, we're actually in a thing called backwardation, which means that your current prices are significantly higher than your future prices, which doesn't make too much sense from an owner's perspective, right? You don't want to be paying upfront for something that's going to be worth lower than what it is today. So that's where I think investors need to exercise caution, because it doesn't look like there's really a shortage. There are narratives around a shortage, there are drivers for demand for sure, but what's happening locally in markets should not be a trigger for you to look at, say, buying or owning more silver at this point. Again, coming back to what we said in the beginning, if you've had a significant run-up and that run-up is not characteristic of this asset class, then you need to question whether you can still make decent returns when you participate in an asset class, or if you're taking far more risk than you need to.
So the conclusion from today's conversation is that no asset is always going to be safe or foolproof from drawdowns. Even gold and silver will be experiencing this. And it's important to look at your investment as a whole in terms of asset allocation. If you want a better risk-adjusted investment journey, do get in touch with us. This is exactly what we do at ithought, and you can drop a message to the number given below.